welcome everybody, and thanks very much for making yourself available on short notice. The budget came out on Monday, and we were talking a little bit about how do we work with it, and we thought, well, let's go to our experts, Kim Moody, who's a member of the organization. But let me start off a little bit. You've seen the news that we brought in a new president, and in January 2018, I got involved with Alberta Enterprise Group. I went on a mission to Nevada, and I met just an incredible group of quality people, and I said, I want to be part of this. So I joined, and a year later, it was kind of the right time for me to come in and help. And so the goal with Alberta Enterprise Group is really to advocate for free enterprise, for business, and very much run shotgun for all of you so that you can do what you really do, which is create jobs and create GDP for the economy and drive this country like you do. So thank you for all the work that you do. As I got involved, we identified that we really were Edmonton centric, and we wanted to be more provincially centric. So we went to work looking at how do we grow across the province. We added Spike Martin to our board up in Grand Prairie. Peter Kiss joined the board, and he does a lot of work up in Fort McMurray as well as Edmonton. In Red Deer, we added Vic Chiba to the board. In Calgary, we added Shane Wenzel and Donna Newman. And so we've really spread ourselves from a board standpoint. And the next stage was, well, how do we grow from a staff standpoint across the province? And then lo and behold, this Connor McDavid became available on the free agent market. And we didn't have to trade any of our resources away. And Danielle had announced that she was stepping away from radio, and there's all sorts of speculation about what she was going to do. But we were smart enough, we're lucky enough to get involved in a discussion with her early, and talked about how we might be able to build the organization with someone like her involved. So we spent a bunch of time, identified it's the right thing to do, and then Danielle accepted our offer graciously. And between the two of us, we think we can really make this organization hum. And so when Danielle was coming in, it seemed so clear to me that she has this brand and recognition. And if you've seen some of the social media and media that's happened in the last couple of days, it's extraordinary how well known she is and how well regarded she is. And it just seemed obvious to make her the president of the organization. And the two of us are going to have nothing but fun building it going forward. So I want to welcome Danielle, very excited about it. And I think this is a great opportunity to use Danielle's great strengths of interviewing with Mr. Moody. So I'll pass it over to you, Danielle, say a few words and away we go.
You got it, John. Thank you so much. And I am so delighted to be on board. I think there was speculation about what I might end up doing. Kim asked me when I was talking to him earlier, he'd heard that I was going to run for mayor of Calgary. And I did consider it, but for me, the political environment right now is just not one that for someone like me who's so freedom loving and free enterprise loving, I feel like we have to do a little bit more groundwork to make sure that we're able to turn around some of the sentiment so that we can start electing more freedom loving and free enterprise loving politicians. So I've got a few projects that I'm going to work on in that regard, but I was delighted to be able to join AEG. I had initially thought I wanted to get back into business advocacy, and Kim knows this because I was hoping he'd put in a good word for me at the Calgary Chamber of Commerce. But as I started talking with Terry and Peter and Tim and John, it feels to me like AEG is just such the right fit. A group of decision makers and wealth builders and job creators who just want to get things done and want to move quickly. And I move pretty quick on things. And so I'm looking forward to working with John. As I said, we've sort of doubled our staff, but quadrupled our influence. And we're going to keep on doing that. I'm also delighted. I don't want to spend too much time talking about me because we'll have more time talking one-on-one. But I'm delighted to talk to Kim Moody today. He reminded me of our first interview, which you guys will absolutely love for me to recount the story, was when David Suzuki was given an honorary degree from the University of Alberta. Moody's Tax had been giving a $20,000 donation each year to support the law school there. And he called up the dean and said, you know what, if this is the direction you're going, honoring somebody who has been so antagonistic to Alberta business, we're going to stop our donations. Well, it created a bit of a firestorm, which you'll probably remember at the time. And I think a bit of a pile on too, as other former graduates felt exactly the same way. So Kim is not afraid to take a strong stance. He's not afraid to tell you his opinion. And I always, after that moment, had an opportunity to, whenever I could interview him about business tax issues, I always made sure to have him on. So let's get right into the discussion. I think that John has sent forward the link that he's done is a full analysis, quite long. I tried to print it off, but I ran out of paper, but it has a 23-point executive summary. And we may not have time to go through all of those, but there are certainly, at least in the first half, some that you're going to be very interested in hearing about that are going to have an impact to you. I think some of the analysis on this has been, this is sort of the goodies budget, and is an election budget. I think John Ivison has suggested that we now know when the election is going to be. It's going to be in September. And so the way Kim has approached this is part one, part two is coming. And so we won't know what part two is until after Trudeau is safely in with a majority government, he hopes. But I think this document gives us a bit of a guide as to where we might end up going. So Kim, with that, why don't you tell us about your part one, part two analysis and give me some idea of what you think of this budget? Because in some ways, there's not a lot in it that's bad on the tax side, but there's so much spending in it that it's got to be coming.
Well, thanks, Danielle, and thanks for the opportunity to appear today, and thanks for your kind words. And certainly as an AEG member, I'm quite tickled that you've joined the organization. So congratulations. And so with that, to answer your question, I clearly do think this is part one of part two. I think the intent was rather obvious. I actually think it's rather disgusting in terms of the spending initiatives. But, I'll give them a little bit of credit because, the pandemic has certainly required extra spending, and I've been complimentary to the government, the federal government, in terms of how quickly they got the money out in the front end. But the amount of money that continues to be spent, and it is in my view, and I'm not an economist, but I speak to a lot of economists, including the esteemed Jack Mintz, and who I actually just interviewed last week, and is frightening. It's absolutely frightening because I think it was John Ivison that said, or it might have been another reporter, it was either today or yesterday, said that it's quite clear that the government has bought into modern monetary theory of economics, which basically means there's no consequences to endless spending, which is nonsense theory. And I think any credible economist would certainly agree with that. And so we have a $154.7 billion budget deficit predicted for the upcoming year. And that's in addition to the $354 billion deficit that, for the previous year, which ended March 31st, 2021, which of course was most of the spending that occurred because of the pandemic, and the wage subsidy was about a quarter of that. And so, the media that came out on this was rather interesting. They're quite proud that they kept the deficit below 400 billion. Well, I'm not very proud of that. I'm actually very frightened by that because part one of this budget that just came out, as I already mentioned, $154.7 billion deficit. Well, how are we going to pay for all that? And so clearly this is part one of part two, and part two comes, if you believe the election is going to be somewhat, there's some people that think that we'll have a spring election. I tend to think it'll be a fall election if I have a crystal ball. But whenever it is, and if the Liberals get safely tucked into a majority, quite clear to me that part two includes all the, maybe some austerity. I doubt it though. I don't think that this government knows what austerity is. This is certainly a different version of the Liberal government back in the Paul Martin days and the Chrétien days, when austerity actually meant something. And so I think we're in for a load of hurt in part two. And as I mentioned in the budget blog that I think you've sent out to to the members who are online. I think the obvious will happen. And there is a lot of speculation in terms of increased capital gains inclusion rate, increased personal tax rates, changes to the principal residence exemption, and a wealth tax. Those are the ones that were mostly speculated, and we contributed to that speculation. I happen to think that some of those four initiatives will ultimately be in part two. And I think the obvious ones will be capital gains inclusion rate increase. I think that's a foregone conclusion, in my opinion, and I'm happy to debate it with anybody. I do think we'll probably see some personal tax rate increases, especially to the wealthy, so-called wealthy. It wouldn't surprise me to see another 2% increase. I think this government can live with high marginal personal tax rates that approach 60%. That's my guess. And would I see continued attacks on the wealthy in terms of more luxury taxes or some sort of wealth tax coming in? Nope, wouldn't surprise me. And so those are the obvious ones, and there will be some very, very targeted measures as well that, I hate this word, loopholes, but will they close down certain common planning that happens today that arguably is not good tax policy? And if there's any accountants or tax people on the line here, so-called surplus stripping, where you can take out money out of a company in the form of a capital gain as opposed to dividend taxation. I was actually thinking that might be shut down sooner. I was looking for it in this budget. Nope, not there. But I could see certainly that coming next election as well. Principal residence exemption, I'm kind of on the fence on that one as to whether it's in part two. I do think there's good policy reasons why they should change the principal residence exemption. I don't think an unlimited ceiling, which we currently have today, is probably the right policy. Whereas other countries around the world, in particular the United States, have a ceiling on the principal residence exemption, where you have multi-million-dollar gains that are being realized. Yes, some of it's inflationary and arguably shouldn't be taxed, but I do think there's a good policy reason why they should restrict it. But do I see the Liberals doing that? It's a real sacred cow, right? And so I could see some of their voter base being alienated, but with that kind of initiative. But on the other hand, it wouldn't surprise me. So anyhow, there's a long-winded
There is,
answer to
and
your
we'll get
question.
let me get into a little bit of it, because I think part of the modern monetary policy theory is that you can just keep printing money and you never have to pay it back if you're lending it to yourself. And somehow you're never supposed to have inflation, so you never have to raise interest rates. So this is all theoretical, but I'm wondering if that is the potential, that they won't come through with tax measures because they think that they can just keep on printing money to make up the difference. Have you talked to economists to give some insight on that?
Off the record, I have, yeah. And the worry with some economists on that point is that if they keep printing without austerity or income tax measures, at some point we get to a debt crisis, like we had in the mid-90s. Again, I'm not an economist, but I like listening and learning. And whenever I talk to economists about that, that quickly comes to the agenda about inflation, of course. And we're already seeing inflation, right? I mean, here's a small micro example. I want to buy my wife a bike for Christmas, an e-bike. Well, have you ever tried to buy a bike these days, Danielle?
No. What's the experience like?
Well, I was all excited, right, to have a bike under the Christmas tree. Turned out that the bike can't arrive until May, and so I thought, oh, okay, well, and how much am I going to pay for that? Because oh, Jesus, that's $1,000 more than I thought I was going to pay based upon the previous year. Yes, supply, and we're having manufacturing problems. So guess when I got a phone call the other day. Guess when the new delivery date is for my wife's e-bike? Mid-August.
You're kidding.
So is that, first of all, an increase in prices and longer delivery, is that a form of inflation? Absolutely. And so we're seeing little micro examples of that already. Where we'll really hit the pocketbook, though, of course, is when the dollar's worth a lot less. And so, and I do believe, and again, I'm not an economist, but I do believe that time is coming if the uncontrolled spending without austerity, without tax measures continues. So
So let me ask you that then, is as you start seeing that inflation occur, you're going to see wages go up. Do you think that there's a strategy that you keep the rates the same, but if you have to keep on increasing employee wages by 3 or 4 or 5% per year, that they're just going to try to inflate their revenues without making the changes? I'm trying to see some future that doesn't include more taxes and a bigger tax hit. Could that be part of the strategy?
That's a good question. I don't have a great answer for you, but it's a good question. I'll just use our firm as an example. I mean, supply and demand. Tax people are in short supply. Not every accounting firm employs tax specialists. Not every law firm, most law firms don't have tax specialists. And so, as the demand increases and as the supply decreases, I mean, what does that do? It puts inflationary pressure on wages.
Mm-hmm.
And so do I see, I hope none of our firm members are listening to this, but can I see inflationary pressures on wages even within our own firm? Absolutely. And so is that problematic? Yeah, because who's ultimately going to pay for that? Clients, because we have to increase our rates. And so that does worry. I don't know if I'm answering your question on that.
Well, you are, because I'm trying to figure out how this all pieces together, because if you keep on taking out a massive amount of debt, the only way you can afford the finance charges is if interest rates stay low. But if you've created a huge amount of inflation, the only way to stem that in is to increase rates. So there seems to be some measure that's not going to work here. Something's going to fail, and I don't know which it is.
When I talked to Jack Mintz about that the other day, his only comment to me is the only way out of this is growth.
Mm-hmm.
Right. And so, because you can grow your way out of this, and the way he explained it to me actually made perfect sense. But where's the growth measures in this budget? I see very little. I see tons of spending, which maybe is their version of growth. But in my view, the way to grow is by letting the job creators free.
Completely.
With the current health restrictions, we're not seeing a lot of that, in my view. But anyhow.
Well, fingers crossed that the health restrictions will be eliminated soon. Yeah, both of us, right? But let's then talk about some of these specific measures, because the first one could be maybe the only thing that they've really offered in a tangible way for how you might get that growth. No personal tax or corporate tax rate increases or reductions, with the exception of proposed 50% corporate tax rate reductions for certain, quote, green businesses. So there's more details to follow, but give me some sense of what it is they're trying to achieve there. What would that look like?
Well, it's very much, in my view, virtue signaling. So if you have a business that somehow contributes to their green agenda, then ultimately you're going to get a 50% corporate tax rate reduction, regardless if you're subject to the lower rate of corporate tax or the higher rate of corporate tax. The ultimate question is, what's a green business and what qualifies? Like, for example, as a law firm and accounting firm, could we be a green business if we went paperless? Which, good chunk we already do, obviously. But if we went completely paperless, do we qualify? I don't have an answer for that right now. So I think the devil is in the details, and we'll see how this plays out. But in my view, that's a lot of virtue signaling.
What if it was to apply to things like wind power, solar power? Do you think that's the direction they're going?
Probably, yeah. And there is some explanation in the budget. I give a short shrift, and it's on the very last page of my budget summary. And the reason why it's on the last page is because that's where it deserves to be, is on the last page. But there is some, under number 22, if your members are, have hurriedly printed out, apparently the manufacturing processing activities that qualify are manufacturing a solar energy conversion equipment, manufacturing a wind energy conversion equipment, manufacturing water energy conversion. So, and the list goes on and on and on, right? But then there's a cost of labor and capital calculation as well that you need to go through. But a lot of the devils will be in the details.
Did you see it, like, is geothermal in there? Is hydrogen in there? Because I know that Annemie Paul, the Green Party leader, keeps trying to say that blue hydrogen should not be included in the green energy future. And so I just want to make sure that they didn't sneak something like that in, that it only applies to green.
Manufacturing of water energy conversion equipment such as hydroelectric. So that's their geothermal energy equipment. Yeah, that's there. I thought that hydrogen was there. Let me just take a look here real quick. Yeah. Manufacturing production of hydrogen by electrolysis of water. I mean, this is so.
Just by electrolysis of water, that doesn't include natural gas then?
Now you're asking real technical questions, and catch me with my pants down. a
You know
little bit
what?
here
I'm going to
because-
look into that because that was my big fear, is that they want to be able to only include hydrogen that's made from wind and solar and not include hydrogen that's made from natural gas, which is
Yeah, I don't
sort
see
of
it
our
here.
base. Oh, boy.
They got
Okay.
manufacturing electrical vehicle charging systems and hydrogen refueling stations for vehicles, but I'm just scanning quickly here.
Okay. I'll
So
take a
in any
closer
event-
look at that one. That's great to know.
Sure.
So let's go on to capital gains inclusion rate. So it hasn't changed, but if we're going to look at part 2, what do you think we should be preparing ourselves for an inclusion rate?
Well, I was our firm was part of the speculators. There's no shortage of chatter on this across the country in terms of, if you got a $400 billion deficit, what are they going to do? Well, capital gains inclusion rate increases is an easy target, right? Because there's a history of this. In 1972, it was 50% when they introduced taxation of capital gains. And then in 1986, I believe it went up to 2/3. In 87, it went up to 3/4, and then stayed that way until year 2000, when it eventually ratcheted its way back down to 50% all in 1 year. And it's been that way ever since, for 21 years. And so I think the natural step up would be to forget the 2/3 rate and go strictly, right to 75. I don't think they're going to go to 100%, would be my guess. So because that would likely discourage some foreign investment. And I don't think they want to completely discourage that, especially with a small country like Canada.
Well, what would be the implications of that? I guess here's what I'm wondering, if they can do this, because if they get reelected in September, and then part 2 of the budget comes in the fall, could they make a capital gains inclusion rate retroactive so that it applies on sales that took place prior to December of 2021? And so we're sort of trapped, that there's nothing that you can do if you want to limit your losses?
Well, history would say no.
Okay.
History would say that they would go forward on that date, and that's what they've done in the past. But I don't think there's anything stopping them from doing that, to my knowledge, legally. But having said that, I think that would be unprecedented. I hate that word, but it would be probably unprecedented for them to do that.
And so what are you anticipating will happen in the meantime if investors get convinced that we are going to see a higher inclusion rate? What would you anticipate will happen over the next few months?
Well, I think we've already seen some of it. I know certainly in our client base, we were concerned about it, and we obviously continue to remain concerned. And so, we proactively are looking for ways to lock in that 50%. So early triggering of gains. We've actually had some clients that are just fed up, and so they're leaving Canada. And when you leave Canada, you're deemed to have disposed of all of your assets at fair market value, which is basically forcing the capital gain at 50%. And so their logic, and proved by our analysis, is that let's lock in that 50% gain today, and I'll be free of Canada's future high tax rates. I'm prepared to pay the 50%, capital gains inclusion rate, but not a 75 or, God forbid, 100%. So there's lots of proactive planning that continues to be done, and I think we should expect that fast and furious.
Okay, I want to talk about this weird new luxury tax. It's not going to generate much money, and it's even applied in a weird way, as we were talking about. So purchase of cars and personal aircraft with this retail sales price over 100,000, and boats for personal use over 250,000. I guess I would have thought boats and cars would have been the lower rate, and it would have been planes over 250,000. So it's a bit of an odd way that they've structured it in the first place. But what's going on there? I mean, how much revenue do you think they're intending to generate off that? Why would they even do it?
Well, it's clearly, in my view, and I say this in the blog, it's an attack on the wealthy, right? It's again, it's virtue signaling. It's pandering to the voter base. From a tax policy perspective, it makes zero sense in my view. And so clearly, it's just because the revenue raise on this that they're projecting is, off the top of my head, I think it's 600 million over 5 years. Well, if you know anything about government finances, that is absolutely zero. It's minuscule. And so why would they do it? Well, they're certainly not doing it in the name of tax equity, because it's a clear attack on certain people that can afford that. I do share your views, though, because we talked offline on this, why 250 for boats and 100 for aircraft and cars? I mean, it's pretty easy, especially with SUVs, to get to 100 grand. And in airplanes, it's almost a given, right? That you're going to get to 100 grand. There's not too many planes that you can buy below 100 grand. And so I really don't understand this. The calculation too is rather interesting. It's 20% of the excess or 10% of the full purchase price, whatever is lesser.
Mm.
And so, and you're going to end up having to pay it if they bring this in on January 1 to 2021, or sorry, 2022, my apologies, at the point of purchase. So the dealerships are going to have to collect it and remit it. And so it's not something that you can dance around pretty easily. So
Well, I
we'll see
wonder
what
what
happens.
might be coming out of that, because they're obviously putting the structure in place for some purpose. Now, let me be conspiratorial here, because you're seeing the conversation take place at the same time that you've got Quebec wanting to phase out combustion engine vehicles, right? So you can imagine if they set this structure in place for vehicles over $100,000, it's probably not a stretch to think that they could put this structure in place for one tax rate for combustion engine vehicles and one for every other type of vehicle. That's one thing that comes to my mind. Is there anything else that you could imagine them using this as a jumping off point to do something worse? Or is it really just to say, let's go get those guys, we'll make them pay?
My sense is it's probably the latter. But having said that, it wouldn't surprise me if they expand the list of luxury goods that are subject to a so-called luxury tax. Cars, planes, and boats are the obvious because they're most visible. But what about going after the non-visible luxury goods as well? That would be harder to administer, I think. But if you put the tax on the point of sale, let's say you go after handbags, you pay and set it so that it's $5,000. If you pay $5,000 for a handbag, somehow you're rich, and therefore they'll do that. Can I see the continued expansion of a list like that? Yeah, I can. I guess there's just no question, or sorry, there's endless possibilities. But where do you draw the line eventually?
Right.
Don't know.
Let's then talk about the wealth tax, because I think this was always proposed. I interviewed someone from the Broadbent Institute, and Jagmeet Singh has talked about this as well. And the notion is anyone who has assets in excess of $20 million, you would charge, I think they said, a 1% rate each year of the wealth over that amount. Now, you've got a couple of problems. Is the capital's mobile, so presumably you just end up with more people setting up in Panama. That'd be one issue. The other issue is that the value of, for instance, farmland or ranching land would be well over $20 million for some of our biggest operations. And so that becomes a new tax on food production. And I suspect that they will generate nowhere near what they hope to. I think they're talking about $7 billion a year if they structure it that way. And my view is if they don't get that, then they'll just start reducing it. Okay, well, we'll apply it on wealth over $10 million. And then if they don't get what they need, well, it's then over $5 million. And pretty soon it's including more and more people. So tell me where you think they're going with that, because that's the alternative proposal to taxing principal residents. And because you're right, politically, taxing principal residents would be hard to get through, but sneaking in a wealth tax way I just described would probably be somewhat easier.
Yeah, I don't disagree with you. And I'm on record of saying that, hey, I'm not in principle opposed to the introduction of a wealth tax. But I'm a big advocate for comprehensive tax review and reform, as you and I've chatted about that on your radio show previously. The last time that we had comprehensive tax review and reform in Canada, it occurred from 1962 to 66 in the Royal Commission on Taxation, which ultimately, after much debate and vigorous debate, it ended up with comprehensive tax reform, January 1, 1972. I don't know about you, Danielle, but I was barely born in January 1, 1972.
I'm 1971, so I was 1 year old. I wasn't following tax policy that closely back then.
Well, I'm 1968, so by age 4, I was following tax policy.
I believe it.
No, I'm kidding. But we have had very limited review and tax reform since that time. And so all to say that, hey, if you think a wealth tax is good for Canada, then let's weave it into an overall review. Like, what if you had a wealth tax that was integrated with your personal tax system and your corporate tax system, so that if you're subject to a wealth tax, then somehow you get a corresponding reduction, so that ultimately it's not a pile on. Well, the NDP, they want a pile on, they want a double tax. I think a well thought out wealth tax, and to a certain extent, this is above my pay grade because I'd have to work with some much smarter people than me. But if you integrated the systems together, then maybe you can get through some of the obvious issues of mobility, calculation, especially on illiquid assets. If it's well thought out so that ultimately people are not motivated to simply shift and change their behavior, then great. And if you look at the current system around the world, Jack was telling me the other day, and I thought it was higher than this. I thought it was 9 countries, but he was telling me it's only 4 countries that are left in the world that have a wealth tax. I haven't confirmed that, but Jack is much smarter than I am, so I'll believe him. But so that tells me something, right? That there's a real problem there. So if Canada goes down that route, just like the United States is at least threatening to go down that route, I don't think they'll actually get there. But then I think we're in for a world of hurt.
Then let's talk about the principal residence tax, because I've wondered for some time, because I think they started requiring you to report the sale of your principal residence 4 or 5 years ago. You can correct me if I'm wrong on that. And you always wonder, why would they do that? They must be doing it for some planning purpose. And so if they did that in conjunction, in the context of a wealth tax, what would it be? That if you had windfall gain of your property over $1 million, there would be a wealth tax on it? Or would it be, because I think we're only really seeing that kind of escalation in Vancouver and Toronto. Maybe it is elsewhere, but give me some sense of how you think it could be structured. Do we have anything to go on looking elsewhere?
We do. And I do like the idea of carving out principal residences from a wealth tax. I think that logically and policy wise does make some sense. So count me in as an advocate for that. In terms of your comment about reporting principal residence exemptions a few years back, let me give you a little bit of history on that. Just technically, and if there's any tax geeks on the line, you'll know this, and accountants, technically you're always required under the Income Tax Act to report the dispositions of your principal residence and the claiming of the principal residence exemption. The Income Tax Act does not allow you, and by the way, just so you know, this is just in case people haven't seen the latest version of the Income Tax Act. This is it, right? It's the biggest statute in Canada by far, and by far the most complex. The Income Tax Act has never exempted people from reporting principal residence exemption. But administratively, the CRA, ever since 1972, said, well, if you're claiming the principal residence exemption, then you don't need to report it. We don't want to see it, which led to a lot of abuse. And I talked about this quite often using my uncle. I throw him under the bus. My uncle, back in the 1980s, thought he was rather brilliant, and I guess he was, because he would buy houses in central Alberta, live in them for a day, because of course the mythology is if you live in it for a day or two, then of course it's your principal residence. And he would dispose of them and make some decent profit. And I'm exaggerating at a day. He would live in them for a short period of time. In a period of 3 years, he moved his family 11 times and claimed principal residence exemption and gains on that throughout that period, and never paid tax and never reported it. Well, if you ever got audited, the first key on claiming principal residence exemption is the property needs to be a capital property. It cannot be inventory. And I think it was John, maybe it was you, that said Shane Wenzel is a member, or board member. Shane would know this very well. Shane Homes, when they sell homes, that's inventory. Like, they're not selling capital property. So all profits are fully taxable. Well, same thing with my uncle. Those are inventories, and he would not be eligible for the principal residence exemption. So these traders would take the position that that was principal residence, when in reality it wasn't. So the change of policy in 2016 was, you know what, we're going to require you to report so that we can take a look and see whether or not you're a trader or not. And I actually think that's good policy, and I think long overdue.
Okay, let me ask you let me ask you from the other side, having
Sure.
made really bad decisions. I'm embarrassed to say. So I bought a $150,000 condo in Edmonton. I last put it on the market for $70,000, and I bought my house in High River for $585,000, and I probably could only sell it for $475 right now. So is there a benefit if you have a cap? If they start taxing the capital gain, doesn't that mean that those of us who have had losses, wouldn't we get some tax benefit on the sale of a loss? Oh, okay, fair enough. It doesn't work that way.
No,
All
I'll
right.
tell you why, just real quick. And by the way, I'm going to put you on the clock on this one because I'll send you a bill. Because this sounds like personal
Okay,
advice.
good.
So a house is considered to be personally used property. All gains on personally used property are taxable. All losses on personally used property are deemed to be nil. So you can't offset. So if I buy a car, personally used property, if I happen to make a gain on it, that's taxable. But if I have a loss on it, which 9 times out of 10 you do, I cannot claim that loss against any gain. So that's just the system's been that way forever.
Wow, stacks against us. Okay, there seems to be a couple of positive things in here. This one's important, and I think it would be, I think we should talk about whether there's a likelihood that this could be expanded, because a major tax change that took place under Donald Trump a few years ago was being able to expense certain acquisitions at 100%. And it sounds like they're making a bit of a foray into that. This is point number 5. So tell us what they've done. Tell us if what it will impact and whether it goes far enough.
Well, that one was a bit of a surprise, I have to say, because there hadn't been a lot of leaks on this. I mean, frankly, almost the entire budget from a tax perspective was leaked the night before, so which I was pretty ticked off about, to be honest. But this one was a bit of a surprise, because I thought the Liberals had basically stated, when they didn't compete with the United States on this a couple of years back, I thought basically that was their policy statement. So to see them come out with this proposal where Canadian controlled private corporations can expense otherwise capital property immediately, up to a $1.5 million limit per taxation year. Now, this is a temporary measure that's expiring in 2024. That I think could be really beneficial for a lot of AEG members and companies. Now, there's some limits on this. It has to be so-called eligible property, and we go into a little more detail what that means. But the short answer is buildings don't qualify. But a lot of the usual equipment that you would think of does qualify. Automobiles or equipment, office equipment, computer equipment, that all qualifies. And so certainly it's something for members to take a look at and take advantage of to the extent that they can.
Okay, I'm going to just suggest anyone who has a question, if I'm not covering the areas you want me to, I'm looking at the chat right now, and you can write it into the chat. John, also, maybe I'll call on you if somebody wants to put up their hand to ask a question to Kim, so that I'm not hogging all the time. I have a few more questions to ask him, but I just want to make sure that you know that there's time for that too, if you want to get your question in. One more thing, I wasn't sure if this would impact our members. I suspected it might, but was the proposal to restrict interest deductions for certain taxpayers. And when you look at this, limiting interest deductions to 40% of a taxpayer's tax EBITDA, this is on point 13 starting in 2023, and 30% in subsequent years. Now, because it's associated corporations and the amount of you have to have a taxable capital employed in Canada of less than, I guess, more than $15 million.
No, less than 15.
Less than $15 million. So give us some sense of what they're trying to do there. And I don't know if you have an example of the type of business that could be impacted by it. I've been talking to a bunch of guys who have big, heavy equipment operations, right? And large trucking fleets. And so this is why I'm wondering if this is going to be a lot more significant for some of our members. Can you get into that a bit?
Sure. Yeah. So this came out in this first got proposed by the Liberals in their 2019 election policy platform, and the NDP, of course, followed suit right after that. They thought, "Oh, that's a great idea. Let's copy it." And it really was a copy of what was happening in the United States, where the United States felt that interest deductions were being used in order to strip earnings, and so they introduced this arbitrary 30% limitation on EBITDA. And so the Liberals introduced in their policy platform, and then 2 years went by, of course, and nothing happened, and it's littered with issues. But in a budget, they come out with this proposal again and say that they're going to consult with stakeholders and release draft legislation later this year, which to me, I think is contingent upon whether or not they get elected again. But having said that, if it does get implemented as they proposed, this could have significant impacts to larger private companies. The smaller private companies with capital of less than $15 million, with their associated groups, won't apply. These rules won't apply. But take the position of, or the situation of a car dealership, for example. And so you have a car dealership, and a lot of them have multiple dealerships, and a lot of them are associated companies and they use floor financing, for example, to acquire their vehicle inventory, and they incur significant interest costs on the floor financing and other financing that they have. And so, does it take long to get, to taxable capital in excess of 15 million? No, just like that. And then what about, net interest cost of 250,000 or more, like that as well.
Mm-hmm.
And so then you start thinking about, are there other types of organizations where this could really impact? And there's lots of them. And so in the case of a dealership, if you're restricted to interest deductions of 30% of EBITDA, well, that could really hurt, because in my experience, at least with dealerships, there could be situations where the interest costs are way in excess. And so if ultimately the deductions are restricted, that could have a huge economic cost. So I worry about this one a little bit, and certainly our firm will be involved in the consultations that they're asking for.
Well, and they don't give you much time to deleverage either. If you're going to be in that position, 2023, that comes along pretty quickly. So you would face a pretty substantial decrease in your ability to do a write-off year over year, it would seem to me.
Yeah. And how do you deleverage certain businesses, like a car dealership? How do you do it?
Can't, I guess. Okay, so Ken Nichols asking the question. I think we did, we jumped over this when we were talking about any changes to capital gains. He's wondering about the dividend tax credits. Have there been any changes there, or do you think anything is coming in part two?
There's been no changes in part one. Part two will depend on whether or not they increase corporate tax rates. And my sense is they probably will. And if they do, then yes, you can expect changes to dividend tax credits.
If they increase corporate tax rates, are we still in an advantageous position in Alberta because our corporate tax rate has gone down to 8%? Can they basically increase it to a point where it nullifies any advantage we have in Alberta, or are we still going to be ahead of the game? Probably
the latter, unless they change the entire game, because provinces, of course, are free to set their own rates. But the federal government would only have the ability to set their rate. So my suspicion would be that they wouldn't screw around with that, and Alberta would still be left in an advantageous position. That's my guess, at least anyhow. Okay, let me talk about a couple of other things. I don't know if they're going to have much of an impact on our members, but just because there are tax changes, just to get your sense of whether they're good moves or not. So let's continue on the discussion of residential real estate. A proposed 1% tax on the value of non-resident, non-Canadian owned residential real estate that is considered to be vacant or underused. This is like the Vancouver Toronto tax, isn't it? For foreign investors who've been buying properties and letting them sit vacant, they're going to punish them. Is that the right move? That's effectively what they're doing. Yes. I query exactly how they're going to do it though, because I think the provinces and the municipalities will have something to say about this. Yeah. It doesn't seem like even if they did tax it, that money shouldn't go to Ottawa. Maybe it should go to Vancouver so they can offset it by providing affordable housing or something. There's probably a better way to do it. Yeah. And certainly some of the chatter that's come through after this proposal. I mean, if you Google this and see some of the chatter on the blog sites and LinkedIn and all that, that has come to the forefront in terms of how they're going to actually do that without undercutting municipalities and the provinces. So I think this is a bigger initiative than certainly the media has made it out to be, that's for sure. But I don't know. I worry about whether or not this will have a negative impact. If you're Doing it across Canada, will it have a negative impact disproportionately?
Yep, we still got you.
Okay, it's just my wife was calling me and it came up on the screen. And
Oh,
so,
no, we can't see her. Bring home milk.
so I was worried that it would interfere with my microphone. Sorry about that, but
Yeah, no problem.
love her to death, but I'll call her back. And now I lost my train of thought.
No,
What
it's
was I
okay.
saying?
We were talking about that 1% vacant property tax and the implication it might have across the country. Because I was thinking it might just be Vancouver, Toronto. You said that there's some backlash happening because it's
Well, let's say I'll pick on my, I've got a cottage in Invermere. Will that impact negatively the Invermere market? Well, is there a cooling effect that needs to happen? Because there are a ton of non-residents that have property in Invermere. I don't know the answer to that, but I would suspect the answer is no, at least comparatively to some of the bigger markets like Vancouver and Toronto are the obvious ones. And so do you need, from a policy perspective, this blanket one size fits all tax? I have to think the answer is no. Because what are you trying to achieve here? Are you trying to achieve a cooling effect and increase available housing? Okay, if you are, then target it. Because some of these tourist towns that rely on people coming in who are non-residents year after year, like in Invermere, there's no shortage of US people that come in year after year, and some of them own property. And is it taking away from the rental availability? Maybe, but prove it to me, because I'm not seeing it.
I wonder.
So, anyway,
I wonder if it would impact Canmore then too. I don't know if that is more Canadian citizens or not. All right, this 3% digital services tax, it's going to apply to large technology companies that derive business from Canadians. So I'm wondering what's going on there, because I noticed that as soon as the budget came down, I got a note from Google where I do one of my mail services, and they said we are now starting to charge you GST. So I don't know if that's a separate tax to this 3% digital services tax, or if it's one and the same. Can you explain that a little bit and the impact it might have?
I think my sense is it's probably different. Because this is not law yet. And so for Google to come out and say that they're collecting, that would be illegal. Illegal is a bit of a strong word, but it'd be inappropriate for sure. But I think what's going on here, well, clearly what's going on is the OECD has been working with member countries for a while to say, okay, you got these electronic companies that are, offering services to a member country, but they're not paying tax in that country, but they're benefiting from their citizens and residents. And by the way, they're collecting their digital information and using that as well, and collecting and selling and what have you, especially Facebook. And so there's got to be a way where we can level this playing field. And the OECD has really struggled to get the member countries to come to an agreement. And this has been going on for quite some time. And so some countries have gotten really fed up and said, okay, tell you what, we're going to just impose these digital services tax. And France, as an example, did that and got the ire of Trump. And I don't know if you remember that little dust up. I think it was 2 years ago, if I recall. And other countries have been following suit. And in the 2019 election, the Liberals proposed the same thing. And so now they're in the budget documents, they're about to do the same, propose to do the same, mainly because they're impatient to wait for a deal with the OECD. And so I actually, on this one, I don't blame them. I mean, these large companies do, collect a lot of money off Canadian residents and citizens and pay virtually no tax and no GST in many cases. And so, policy-wise, I think it makes sense. We can debate whether it's 3% or what is the right number, but in the interim, I do agree that something should be done. Now, who is ultimately going to pay? The consumer, right? Because they'll certainly pass that along.
All right. John, I don't know if you've seen anyone put their hand up that wants to ask a question. I don't have anything else coming in on the chat, but if there's something that you want to ask him, now's your chance, because we're getting close to ending our time. Let me ask you about tax leakage, is what I think the bureaucrats like to call it. But the idea that you can use legal tax avoidance measures if the jurisdiction you're in gets too onerous. I just noticed that there's a couple of things in here about funding the CRA for various initiatives. They talk about strengthening taking steps to strengthen and modernize Canada's general anti-avoidance rules. I'm just wondering if the government's introducing targeted new rules that will eliminate abusive tax avoidance collection strategies. They seem to be quite concerned about leakage. And so what do you make of all of that?
Well, some of them are certainly well-founded, right? The tax collection avoidance one that you read there, that one, frankly, I'm not very familiar with, because our firm has never done that for clients to try and, hide the P of, so you owe some tax. Oh, let's go and hide that P, so that they can't, leave them with an empty shelf so that the CRA can't collect tax. If it's as bad as I think it is, then, that's borderline fraud. And so should the government go after stuff like that? Absolutely. Where I get a little annoyed is the constant trumpeting that, especially from some of the left-wing radicals, that there's all this money that's sitting offshore. All you need to do is just go after that, and we'll solve all of our budget problems. I sat on a parliamentary committee recently at the House of Commons Finance Committee, and one of the co-panelists that was on there was a subscriber to MMT, and also a subscriber to the, that there's all this offshore money that's out there. And I said, with respect, sir, I think you're misinformed. Well, of course, doesn't agree with me, and that's fine. But I live this day to day. I'll tell you that I don't see even close to the amount of offshore money. Maybe in the old days where you wanted to hide your money and not pay tax. And I mean, even then it was evasion and criminal. But I can tell you today, in the electronic world, unless the CRA has some sort of data that we don't see on a practical basis, I'm not seeing it. So to see this trumpeting of language continuously that we're going to go after offshore and go after tax evasion, well, you need to go after tax evasion. That's criminal. So that kind of stuff, which is used as a screen, in my view, to put more money into the CRA, kind of bugs me.
All right.
But anyhow, I could go on and on.
Well, yeah. And I wonder, you said that there's, because you've been studying tax policy since you were 4 years old in 1972, which I do believe, you said that there's some wonky kind of tax policy things in here. I just want to make sure we haven't missed anything important for our members to know about. Is there any other things you want to highlight?
Danielle, can I jump in with a question coming in?
Is that John? John, go ahead. Yeah.
Ralph Hutchinson was just asking, how does the government deal with hyperinflation if it happens, which is an aggregate supply can't keep up with the demand? Can you comment on that, Kim?
Oh boy, that's a Jack Mintz question, isn't it, John?
It is, yeah. But it's a really serious one. That's sort of where we began. I just don't know how they think this is going to work. You can't print money forever.
I don't actually, because I'm not an economist, I actually don't know how they would deal with that. But would you ultimately have to increase tax rates or austerity of some sort? It seems to me that those are the only obvious answers. Cut services or increase tax rates, or broaden the base, as Jack says. So, but unfortunately, I'm probably not the right guy to answer that question with a lot of intelligence. So my apologies.
Let me ask you sort of a broader question about what would be, if this was a pro-growth budget, what would it be? Because I'm always very suspicious of, and I should mention, one of the things we talked about off air is the way this is structured is they're buying off the young people with children with the universal daycare program. Then they're buying off, I think, those of us in the middle with the notion that the vaccines will finally be rolled out and we'll all be able to get back to work by September. And then in September, there's changes to OAS so that if you're over 75, you're going to see a 10% boost. So they've managed to structure this in a way to win the maximum number of votes and give the impression that they'll just stick it to the wealthy and they'll stick it to the corporations and everything will be fine. So that's not going to work somehow. So what would be the reverse? What should we be looking for if somehow Sweet Reason took over in part 2 after the next election? What would you want to see?
A big one is a reduction in personal tax rates. I mean, there needs to be rewards for taking all the risk. You got to encourage the job creators to take that risk. And a lot of it starts with personal tax rates, and a lot of it, in order to attract top talent from around the world, starts with personal tax rates. I'll use my firm as an example. When we try to hire U.S. tax lawyers, You know, unless we're hiring from California, which of course is a higher tax rate than Alberta, you know, we're often competing with states that have lower tax rates, significant lower tax rates, and a lower dollar. And so it's really hard to attract top talent with high personal tax rates. So that's number one. Number two is to stop the death by 1,000 cuts. And, you know, that goes to what Jason Kenney is trying to do, in my view, with, you know, the red tape reduction stuff and what have you. And I think we need to really do a lot more of that. And again, I'm not an expert in that, but on the tax side, you know, the employer costs, the employer CPP costs and EI costs, you know, have certainly come down over the years, but CPP, I mean, that's a big cost. And every time it goes up, which it will continue to go up here, you know, that discourages, you know, employment, and because profits go down, and then you see some gamesmanship, which okay, I'll hire you as a consultant instead of an employee to avoid CPP, and that comes with a whole host of employment labor. So let's get back to a more reasonable ground on that. So I think those are, and then lastly, I guess, would be keep the corporate tax rate low.
Mhm.
I do like what has been happening, and we need to continue to be competitive on that. And right now, I think we're in a decent spot. We just need to allow the economy to generate some profits to take advantage of that.
All right. Thank you so much for taking so much time to walk us through all of this. I want to be respectful of people's time and try to end on time. My boss would always get mad at me because I always blew past my mark. So I think we're ending at least 90 seconds early. But we've given everybody your email and your analysis, so they can be in touch with you, and also they can check out your analysis online. John, I don't know if there's anything you want to say by way of wrap up, but thank you everybody for tuning in today. We hope to do a few more of these.
Thank you, everybody. And I think Kim's last comment in regards to, you know, what we have to do is create a culture of supporting the risk takers. That's all of you, so that you can do what you do, which is create employment, create opportunity, and create GDP. And so we will continue to battle on that front. Again, Danielle and I are pretty excited to be the dynamic duo, and we're going to cause a lot of trouble over the next while. We do need to grow, and so we want to grow across the province. If you have businesses that you think should be joining us in this battle, we need to take away the government telling us, and we need to start to tell the government how this thing should work. So that's the goal. Looking forward to, you know, a great future with AEG, and again, Danielle, welcome aboard.
Oh, my great pleasure. And we'll talk to all of you one-on-one as we go forward over the next few weeks. Looking forward to that. Thanks again, John, and thanks, Kim.
Thanks a lot.
Thank you, folks.